everyone, my name is Kanchan Yadav and welcome back to Learn Accounts with Kanchan. In today's video, we are going to understand one of the most important topics in accountancy, which is none other than ratio analysis. So in this video, we are going to understand its meaning, importance and also most important formulas. So without any further delay, let's begin. Now, what is ratio analysis? Ratio analysis is a technique used to analyze the financial performance and position of a business by comparing the different figures from its financial statements. In simple words, ratio analysis is equals to comparison of financial figures. It helps us to understand the profitability, liquidity, solvency and efficiency. Now the $1 million question arises is that why is ratio analysis important? Ratio analysis helps to management and other users also. So it measures the business performance, it compare the current performance with previous years, it compare one company with another, identify the strength and weakness and make better financial decisions. Also, it understands the financial position of a business. Easy line to remember is that ratios convert the complex accounting figures into meaningful informations. Now, the types of ratios. There are four major categories of ratios, which are liquidity ratio, solvency ratio, activity or turnover ratios, or profitability ratios. So, liquidity ratio here the measure the ability to pay the short-term liabilities. Solvency ratios measure the ability to meet long-term obligations. Activity or turnover ratio, it measure how efficiently assets are being used, and profitability ratio measure the earning capacity of a business. Now first one is liquidity ratio. So here current ratio is equals to current assets divided with current liability. For example, current assets is rupees 2 lakh and current liability is rupees 1 lakh, then current ratio would be 2:1. This means the business has rupees 2 of current assets for every rupees 1 of current liabilities. Generally accepted standard is 2:1. Now the next one is quick ratio, also known as the liquid ratio or the asset test ratio. So in this, the formula of quick ratio is quick assets divided with current liabilities, where quick assets equals to current assets minus inventories minus prepaid expenses. General accepted standard is 1:1. It measures the firm's ability to pay its current liability using its most liquid assets. Then solvency ratios. Debt equity ratio. This ratio shows the relationship between outsiders fund and shareholders fund. Formula is long-term debts divided with shareholders fund. For example, long-term debts is rupees 4 lakh and shareholders fund is rupees 2 lakh. Then debt equity ratio would be rupees 4 lakh divided with 2 lakh, which is 2:1. A higher ratio generally indicates greater dependence on borrowed funds. Now the next one is proprietary ratio. It shows the relationship between the shareholders fund and total assets. Formula is shareholders fund divided with total assets. It indicates the extent to which the assets of a business are financed by the owner's fund. Now the next one is activity or the turnover ratios. Inventory turnover ratio, it measures how effectively inventory is managed. Formula is cost of revenue from operation divided with average inventory, where opening inventory plus closing inventory divided by 2 is equals to average inventory. A higher turnover generally indicate fast movement of inventory. Now the next one is trade receivables turnover ratio. It measures how effectively a business collects money from its credits customers. So formula is net credit revenue from operation divided with average trade receivables. A higher ratio generally indicate effective collections from the customers. Now profitability ratio. Here gross profit ratio, which is equals to gross profit divided with revenue from operation into 100. Example is gross profit is rupees 40,000 and revenue from operations is rupees 2 lakh. Then it would be 40,000 divided by 2 lakh into 100, which is 20%. It shows the percentage of gross profit earned on revenue. Net profit ratio. net profit divided by revenue from operation into 100. And example, net profit is rupees 30,000, revenue from operations is rupees 2 lakh, then it would be 15%, as 30,000 divided by 2 lakh into 100. It measures the overall profitability of the business. Now operating ratio, here formula operating cost divided by revenue from operation into 100, where operating cost equals to cost of revenue from operation plus operating expenses. So a lower operating ratio is generally considered better because it indicates that a smaller portion of revenue is consumed by operating costs. Now the last one is ROI, which is also known as return on investment. ROI measures the return on the investment made in the business. Formula is profit divided by investment into 100. For example, profit is rupees 50,000 and investment is rupees 5 lakh. Then ROI would be 50,000 divided by 5 lakh into 100, which is 10%. So now let's recapitulate it. Quick revision. Category: liquidity, solvency, activity and profitability. So important ratios are: in liquidity, current ratio, quick ratio; in solvency, debt equity ratio or proprietary ratio; then activity, turnover ratio and trade receivables turnover ratio; in profitability, gross profit ratio, net profit ratio, operating ratio and ROI, means return on investment. Easy trick to remember them is LSAP, means liquidity, solvency, activity and profitability. Remember, liquidity pays, solvency protects, activity performs and profitability earns. Now for your better understanding, here is a practice question. Calculate the current ratio, where current assets is rupees 3 lakh and current liabilities is rupees 1,50,000. So the answer would be current ratio is 2:1, as 3 lakh divided with 1,50,000, which is equals to 2:1. Thank you everyone. If you found this lesson helpful, please like, comment, share and subscribe to Learn Accounts with Kanchan. Till then, stay safe, stay healthy and have a good day.